All right. Welcome back, everybody, to another episode of Built to Scale. And I have my compadre here, Layton Johns. Thanks for joining me, Layton.
Of course, glad to be here.
Awesome. Continuing with the theme, y'all, that in previous episodes, we have been diving into elements of the big, beautiful bill. Last episode, we dove in specifically into depreciation, the 100% bonus depreciation written into the bill, both for equipment as well as for QPP, qualified production property. In this episode, we are going to dive more into economic opportunity zones. This is actually not something new. That economic opportunity zones were originated in the original Tax Cut and Jobs Act back in 2017. But, the provisions around them have changed. And what our intent here is to do is to generally provide, some insight in regards to how construction companies can take advantage of elements of this tax bill related to economic opportunity zones. One, it could just be from, personal investments of construction business owners, but another could be that where do the business development opportunities lie? And that's where we're actually going to spend majority of our time is how can construction business owners be thinking and strategizing their business development and their new opportunities around, what's written into this tax bill and the opportunities that exist in this tax bill. So, sound good to you, Layton?
Sounds great.
Awesome. So let's kind of start off because I do feel like this is one of those elements of even the Tax Cut and Jobs Act that I don't think was highlighted in a big way. And it's a very nuanced area of the tax code. There's certain provisions that allow you to qualify for it. And even then there's ways of how you can invest in economic opportunity zones. So I thought it'd be good. I pulled this directly from the IRS website. What is the definition of an economic opportunity zone? It is an economic development tool that allows people to invest in distressed areas of the U.S. So, the way that economic opportunity zones came about was that they are generally lower income per capita areas of the United States that each state gets to elect and qualify particular opportunity zones that it then lifts up to the federal government and says, please certify these as economic opportunity zones. That's really important to understand because those economic opportunity zones can actually change over time because every 10 years, and as it's written into the big beautiful bill now, every 10 years, those economic opportunity zones will be changed. And the existing zones may not necessarily be zones as a part of, will not necessarily be part of the new round going forward. But nonetheless, going back, the economic opportunity zones were founded. They were created low income per capita areas of the United States. That doesn't necessarily mean that they were rural, or that they were in particular, regional areas. Like I looked up, for example, current, economic opportunity zones in Texas, and I'm in Houston, and there are areas of Houston proper, the metropolitan parts of Houston that are actually economic opportunity zones. There are also a lot of rural areas as well. So it's a mix. But these were created ultimately with tax benefits for investors to invest funds into these zones. The biggest part of this is deferral of capital gains. That is the biggest tax benefit of this is deferral of capital gains. And I want to dive into there further, but is there anything you'd like to add to that based upon your knowledge of economic opportunity zones, Layton?
No, you covered a lot of it. So, you think about any kind of a tax code, it's the government incentivizing you to do something that it wants you to do. And in this case, it saw that there were these communities that needed to be built up further, that they were kind of these economic, quicksand areas where it was very difficult to get anything kind of new development traction going. And here they've created an incentive for developers to go in and spend the money in these areas.
And to that point, the original tax bill, the way that in the Tax Cut and Jobs Act, the tax benefits that it created for investing in economic opportunity zones was the idea that you could defer your capital gains. So if you had a capital gains event where You had an asset or an investment that you sold. If you moved and reinvested those funds from that sale within 180 days into an economic opportunity zone, you were eligible to defer your capital gains until the end of a particular, the 10-year period of that economic opportunity zone. But if you ultimately ended up selling your assets, through particular stage periods, that if you held those economic opportunity zone investments, you could actually start to deduct the amount of capital gains from that original investment. In addition, if you held your investment for an entire 10 years in the economic opportunity zone, if you eventually sold your investment in the economic opportunity zone, so you sell something, you defer capital gains, you place in the economic opportunity zone, you hold the economic opportunity zone investment for 10 years. If you held it for 10 years and then you decided to sell it, you would have no capital gains on that final sale of the investment in the economic opportunity zone. That's generally how it works. There's provisions, and how much you could deduct of the original capital gains is based upon how long you hold the investment in the economic opportunity zone, whether that's 5, 7 years, etc. But that's a part of the original tax code. And to all of that, you also can't just necessarily go buy an investment in an economic opportunity zone. And I think this is one of the more nuanced parts of it. Nuance not necessarily meaning bad. It's just there's layers that you have to go through, and that you have to make sure that from a compliance standpoint are solid. You can't just go say buy a piece of real estate in an economic opportunity zone and all of a sudden you can be able to claim the benefits, the tax benefits. You have to invest in an opportunity. I believe it's called an opportunity zone fund or an opportunity fund, and you can either invest in one or you can make one. In order to make one, you have to actually file with the U.S. Treasury Department, and you actually have to make a legitimate fund, like an investment fund. And there are compliance measures that state that you have to have 90% of all of your assets invested into the economic opportunity zone, and you will be compliance checked on that on a regular interval basis. And so the U.S. government wants you to invest these funds, but they're going to validate that you are in fact doing what you say that you're doing. And they want to be sure that your funds are being distributed into those zones. But you have to do it through a fund. You can't just own an asset outright. There's also, it appears that there's no real limits to the types of assets you can hold. They could be high-end assets in an economic opportunity zone. I mean, I read that, there were examples of like, you could have a pickleball court, as long as it was an economic opportunity zone, it's a legitimate investment. So it's not like you had to hold a particular type of asset, although they show statistically many have invested in residential real estate. That has particularly been the main investment, product or asset class that many people have used in these economic opportunity funds. But you can invest in really anything. That, Layton, am I missing anything here? Anything you want to add there?
No, I mean I've understood it the same way, as that basically any type of real estate holding is fair game, whether that's you're buying, like you said, residential multifamily real estate or pickleball court or manufacturing. Really, the anticipation is that we're eliminating empty vacant buildings. We have people coming in and investing in order to revitalize an area, and that can take many forms.
So let's kind of talk through so far the changes in the Big Beautiful Bill. We've kind of given an oversight of the original elements of what was in the Tax Cut and Jobs Act. Let's kind of talk through the Big Beautiful Bill and the changes that I'm going to kind of go through, and I want you to add in, Layton, here. But one of the things is actually they've added that the potential deduction available for capital gains from an original investment. So again, because this is the nuance part of it, if you have a capital gains event within 180 days, you can invest in an economic opportunity zone, and you get to defer those capital gains. And if you hold that investment for a period of time, a set period of time, you're eligible to ultimately reduce that capital gains from that original investment. And then whatever you hold as the investment, if you hold that for 10 years in the investment in the economic opportunity zone, if you hold it for 10 years, you will have no capital gains on it when you eventually sell it. They have now added additional incentives related to economic opportunity zones in rural areas. And so there's actually a higher amount of deduction on the original capital gains available if you specifically invest in a rural area. And the definition of that, from what I saw, was a community of 50,000 or less people. Now, that's nuanced. It's not a township of 50,000 or less people that has city lines next to a city with 1 million people, right? That's not really included. It's literally, in a pretty rural area, out in boondocks might be the wrong way to say it, but a rural area where the township doesn't have any surrounding city limits with cities that are much, much bigger than it. And the community is roughly about 50,000 or less people, that there are greater incentives now to, deduct or reduce your capital gains if you invest in those rural zones. Follow me, Layton. Anything you want to add there?
Yeah, that's exactly right. And so what effective was being done, as Mason mentioned, if you look at the current maps, you may see that there's properties that are available, they're in the near the greater Houston area, and that's not really a, poverty level area. It is a big metropolis. And so they are trying to eliminate people that were probably flocking to those areas and leaving the other areas fairly ignored.
I think that's, we're kind of walking through this, but let's kind of highlight some of the summaries or the takeaways, because we'll kind of do a wrap up at the end. But, for construction business owners, for builders, the idea is that there is going to be incentives for developers to develop in rural zones. That's the key here, is that, and it can be any type of development, and combined with what else is in this big, beautiful bill, especially for manufacturing, et cetera, and qualified production property. Ultimately, it's a combination of what the federal government is trying to incentivize is a lot of qualified production property, meaning manufacturing sites, packing sites, et cetera, being built in rural zones, rural, low income per capita zones. If we could say, like, the big takeaway here is that they are trying to incentivize developers to go develop or to refurbish existing facilities, manufacturing facilities, packing facilities, et cetera, put two things together and make something new in rural zones. Does that feel fair to you, Layton? Does that seem like that's kind of the big takeaway we want everybody to understand?
Yeah. So the play that we're getting at is go and invest in building up a manufacturing facility in an opportunity zone, depreciate it 100% in the year you put into production, and then sell it in 10 years. Don't pay any capital gains.
Exactly. That's exactly what we're saying. And obviously, to all of this, as a builder, if you're not necessarily, segmented in your target market and your skill sets aren't in building manufacturing facilities, hey, those manufacturing sites are going to need people to ultimately fill the plant. And that means that there's going to need to be houses. There's going to need to be other retail centers built. And so there's going to be ancillary effects to this, right? That ultimately there's going to be development around these manufacturing facilities and sites. And those are going to be opportunities. So really, it is look towards rural, low income per capita zones, and look towards manufacturing sites and surrounding services and residential housing to be built. And generally, we would say that we see opportunities opening up there. And from a business development standpoint, you should be aiming at that. It's not to say that there's not other opportunities to aim at, but the federal government has incentivized that development. You should be aiming at that. That's where developers are going to be putting their money and their dollars.
Yep. So I think that for contractors, the play really is, and what we're trying to get out of this is know what is likely going to be built in the communities that you're serving, and then with that information, be able to go and market your services to the people who are likely going to be building those projects. And so we've gone over industrial. The multifamily, I think, is gonna be a big one. I think that we are drastically underserved in terms of residential construction nationwide, and so there's going to continue to be a push for that. And I think that the lower income housing, multifamily type properties, apartment complexes are going to lead the way rather than single family homes. And so developers are going to be looking in these areas because they're going to get an extra tax benefit. It makes the deal pencil a little bit easier when they go to look at doing that deal.
Yeah, I think you bring up a good point about the multifamily because even statistically, they've said that of the developers that have taken advantage of this tax benefit as a part of the Tax Cut and Jobs Act in the past, a lot has gone into multifamily residential construction and development. That the reality is in a low income per capita area, there is not a lot of liquidity to go put a down payment on, a home, and they're likely, there likely is not the credit scores to do it either to qualify for mortgages. And so, the reality that people are probably going to be renting apartments. That's what they're going to be able to afford. And so, that idea that there's going to be quite a bit of development in that, respective area. Again, incentivizations around manufacturing sites, but from a residential standpoint, I agree with you that I think people's liquidity in this country, it is kind of a sad thing to think about, but I don't know that everybody is necessarily going to be a homeowner like they thought they were. And that's just the nature. I think that home prices in this country have outpaced, wage inflation to a significant degree, and people just don't have the liquidity. So, that multifamily is going to be a bigger and bigger part of our general economy, and that's what's going to happen in these rural zones too. So, or if I had a crystal ball, that's what I would say as well. So, yeah. To detail out, you know, especially the rural, tax benefits. So, uh, in the new bill and the big beautiful bill, it is written that if you take your capital gains, invest 180 days in a economic opportunity zone through an economic opportunity fund, and you hold that investment for 5 years, at least at minimum 5 years. If you hold it in a non-rural zone, you will get a 10% deduction on the capital gains that you would have paid from that original capital gains event, and you would have deferred it up until that 5 year period in which you eventually did sell your investment in the economic opportunity zone, and then you would have had to pay, the capital gains at that point from the original capital gains event, and you have a deduction of 10%. If you invest in a rural economic opportunity zone, you now get 30%. So it's a 20% difference if you invest in a rural economic opportunity zone. And so those are really the details. Like, there is an incentive to go invest in rural areas. Let's talk a little bit, because that the key of this is, you know, who is going to be making these types of investments, right? And I think we've thrown around the word developer quite a bit. I don't really see, especially given the fact that you have to invest in a fund and or create your own fund, and you have to go through compliance measures if you operate and manage your own fund, that you have to prove that your assets are invested in, an economic opportunity zone. 90% of your assets are invested in economic opportunity zone. Um, this really seems like it's more high net worth developers. It's going to be institutional investors that are probably going to be making these plays. It's not to say that, a single, investor couldn't open up their own fund or go invest in their own fund. I Googled literally before we did this recording. I will say I Googled funds available to invest in. Not a big list came up, right? That it didn't seem like this is heavily marketed. So I see that this is probably something that bigger developers and bigger institutional investors are probably going to be the ones taking advantage of. What are your thoughts on that, Lane?
Yeah, I can agree with that. It's likely going to be a more sophisticated investor. I think that a lot of developers and investors are probably a little bit more familiar with the 1031 exchange, where that allows them to defer their capital gains tax bill. They can continue to roll their growth of their real estate portfolio, I guess, indefinitely. And if it's in a trust, you eventually can pass it on to your children at a totally stepped up basis. So they basically wipe out the capital gains tax bill in its entirety at that point. Um, that that one, while the implementation of the actual transaction does have some nuances itself, you can invest anywhere. And so I feel like your average investor who may be kind of growing their portfolio is more likely to invest where they're comfortable rather than trying to put together a fund and a strategic plan, especially over a long term. Committing to 10 years is a long commitment. And a lot can change in 10 years. We've seen that from an economic standpoint. The world can be in a very different place in 10 years. And so I think a lot of your smaller investors, unless they're a long-term buy and hold type investor, they probably are not going to be going after these kinds of plays.
I generally, once compliance measures and compliance checks come in, yeah, it kind of, how do I say, it deters away, more simplified investors that just want to see, an easier rate of return and easier management of things. But for more institutional investors that actually have an office that, can manage, those compliance reviews and, just keep things in check. And, I think they're going to be the ones to take advantage of this. You know, yeah, this is nuanced, right? I think, Trump is definitely targeting a particular type of investor in this. Obviously, he's trying to target, manufacturing sites or qualified production properties being built in rural zones. Um, you know, at the same time, though, the big idea of this, you could go invest in economic opportunity zone, and if you held the investment for 10 years, you get a stepped up basis, like you said, and you ultimately don't have to pay capital gains if you decide to exit that investment after the 10-year mark. You can definitely do that. At the same time, the biggest benefit comes from if you have a capital gains event that you need to figure out what to do to reduce that capital gains and defer it. And then you go invest in economic opportunity zone. I guess what I'm saying is you can invest without that original capital gains event, but the greatest tax benefit does come from having that capital gains event. And that's what makes this a bit nuanced too, is that um, it's definitely incentivizing people who could be selling assets at the same time, and trying to figure out what to do with it. At the same time, it's also incentivizing people to sell their assets because there are opportunities in this. And so it gives them a deferral strategy. But the key thing to this is you need that capital gains event, that which most people don't necessarily have, $10 million hanging around to go start building a multifamily residential site, right? They usually have to sell something. So it makes sense that there's that capital gains piece to it. But again, I guess is what I'm just calling out is that for most people thinking of, could this be an investment opportunity? Yes, it could. Your greatest tax benefit is going to come from having a capital gains event. That if you just have money lying around and no assets for some reason, just liquid assets, which, hey, great. If you have that much money, good for you. But if you just have liquid assets, you're not going to maximize the total tax benefit from something like this. There are provisions to this in regards to the deferral of capital gains where this really comes in. Any additional thoughts there, Layton?
Yeah, I think that it's definitely going to incentivize a sale. I don't know how effective that actually was with the first bill. Um, because like you said, it doesn't seem like a whole lot of people took advantage of it the first go round. Now, I will say with the changing of the maps, and so it looks like they're going to, like you mentioned, going to update the maps every 10 years. So, maybe you didn't have a very good area that you wanted to invest in previously, but that might change in this next go round. I will say a lot of people who take advantage of these types of things, even the 1031 exchange, you have to be very forward thinking and know I'm going to sell, therefore I need to prepare myself for what I'm going to do with the funds after I sell. And so it's a much more proactive process than being reactive to the market.
Obviously, there's alternatives to capital gains deferment, like you said, a 1031 exchange. There's other things too. So this has to fit. Like there has to, while there's additional incentives here, this has to fit. This is nuanced, and so it has to make sense. And like you said, it's a very long-term play. I mean, right? They put in 5-year incentives for, reductions in capital gains from the original capital gains event. You have to stick in the investment for 10 years to get the full step up in basis so that you exit the investment in the economic opportunity zone with no capital gains. It's a long-term holding period. Like it is something to really consider, that you want to do. But, again, for our audience, that there are investors and developers that will be taking advantage of this, especially that 30% piece in the rural zones. And, once they combine that with a 100% bonus depreciation on a qualified production property, and I think that's what's different, at least what I see. Maybe we could have gone back and researched the Tax Cut and Jobs Act just a bit more, but I think it's that combination that makes this powerful. Like, I guess what I'm saying, Leighton, is in my personal opinion, this little nuanced part of the economic opportunity zones, it's okay. That's my personal opinion of this. When you combine this with the 100% bonus depreciation on QPP on qualified production property, that's when it starts to become really powerful. When you put those two together, that's what really makes this a powerful combination. And that's why you can't, look at this tax bill and look at it in isolation either. That, you have to see how does all these little pieces fit together. But you really, my opinion of the economic opportunity zone tax code provisions is, nah, it's so, it's okay. Do I think that it's going to move mountains? No. Will it begin to move mountains with 100% bonus depreciation on QPP? Yes. What are your thoughts?
Yeah, I think that there's a lot of people who are going to view this tax bill and they're going to look at, okay, what are the new tax tables? Now I got these tips that I don't have to pay taxes on. I got overtime I don't have to pay taxes on. Those are the big kind of sexy headlines that come out of this. I think that we're going to find the more sophisticated individuals are going to look at this next layer deep. And like we've mentioned, potentially stacking a couple of these tax laws on top of each other to where now there is a very large benefit. On its own, I would never force an investment into an opportunity zone in order to get this. It would have to be, this is the perfect building for me, this is the perfect project, and I get the opportunity zone bonus because of it. But when you're able to stack some of these tax laws on top of each other, you go buy or build a qualified production facility in an opportunity zone, you get 100% bonus depreciation. You effectively pay no tax on whatever income you're making for potentially multiple years out of that facility. Then you get to where you go to move on from that facility and you avoid capital gains tax. You're talking a very, very large tax bill that you've just wandered away from. And but it does take a lot of forethought and planning. And again, I would never force my project into a particular bucket, but if it happens to fit and you're aware of it, a little bit of preemptive planning can go a long way.
So we've kind of given some summaries as to how builders can be thinking about this, especially from a business development standpoint. I don't necessarily know that I would advise, a construction business owner that, if you're making some good margins, you have some good cash flow in your business, you got an extra $500,000 that you can distribute out and do some investments with. I don't necessarily know that I'd say, hey, take your money and go invest in economic opportunities and an economic opportunity fund. I don't think that's what we're necessarily getting at here. That this is the goal here is really aiming at for your construction business, where do you want to target new opportunities? And so, simple takeaway is start to rub shoulders with developers that literally do develop, qualified production property and that are willing to look at these rural zones and that are actually wanting to seize these opportunities. Try to figure out who they are. Go to the right events, associations, rub shoulders with them, start to get in front of them, start to be aware of them so that they would want to use you on their project. That's, if I could have a simple takeaway here, go do some business development in those areas and try to get those jobs.
So I know from a marketing standpoint, myself as a developer, and I've also played the contractor role. As a developer, if a contractor came to me and knew how to speak my language of what's going to make my development tick or what's going to make it more profitable, that person's going to be very interesting to me. I'm going to have more conversations with them, and heck, I may hire that person because they get what I'm doing. And so, just getting a little bit of a background and education into what these tax laws are and how they could affect your potential customers, and then having those conversations. This is a relationship-based business, and I guarantee you, if you can have those conversations with your customers, you will have more customers in the long run.
Yeah, it's knowing your customer's business is just a key part of it. Knowing what drives them and what they're thinking about, you're just going to align yourself better. You're really going to, build that relationship better. There's going to be more trust established that you actually know what you're doing as a contractor, and that you understand their end goals. And that's the key of it. And that way, you're not only playing a price game, you are playing a bigger strategy game with them and thinking about the future with them. So completely agree. Well, thank you, Layton. Is there anything else you'd like to add, about this? That I think we've covered off on this pretty good in regards to pros, cons, key takeaways for builders. Anything you'd like to add?
No, I think that this is a probably more, like you said, nuanced and complex piece of this tax law. It's not for everybody, but just being aware of it, I think will be beneficial.
Thank you, Bud, for joining me today. We're diving into some deep topics here, and appreciative that we saw recently, on YouTube, one of our shorts related to bonus depreciation got, I think it's close to like 2,000 views now. So obviously, this is resonating with people that wanting to understand this about the big beautiful bill. So appreciate you joining me, Layton. I appreciate our audience that. Thank you for listening in, and we'll catch you soon. That we're going to keep deep diving additional topics on this big beautiful bill. So we haven't decided on the next topic. We'll let everybody know, but ultimately we're going to keep diving in to understand how this can help builders and what they should be considering, because a lot of this is actually retroactive to January 1st, 2025 as well. That this stuff is in play now, and so these are things that we can begin to take advantage of with some of our clients, and builders can begin to take advantage of in this year. And we need to make sure that we're doing that. So appreciate everybody listening in. Thank you, Lane. Appreciate you, bud.
Thanks, Mason.
Hi, everyone. So if you enjoyed today's episode and you found value, or it raised some questions for you about the next best steps for managing your finances in your construction business, please reach out to us at bradycfo.com. There's a contact page there where you can fill out, and that will come straight over to us. Either that, or you can personally find me on LinkedIn. My name is Mason Brady, and feel free to send me a message, and happy to chat and talk through anything you're facing today, and happy to provide some advice. So thank you all. Appreciate it. See you.